Hello, my name is Troy Atkins, and I am the founder and owner of Adkins Capital Management. Adkins Capital Management is a housing advisory services company. I want to talk to you today about the key events that have transpired in the U.S. residential housing market during the second quarter of 2022. During the second quarter of this year, a review of the State of the Nation's Housing Report by the Joint Center for Housing Studies of Harvard University and the monetary policy actions of the Federal Reserve to help curtail the impact of inflation on the U.S. economy were the primary topics of conversation. This movie presentation also provides an overview of the home price level for a select group of cities that make up the Atkins 60 City Home Price Index, and it provides a wealth of information for prospective homebuyers to use in order to make a prudent home purchase decision. This presentation was written, narrated, edited, produced, and published by Troy Atkins. I am the founder and owner of Adkins Capital Management. Adkins Capital Management is a privately owned and independently operated company. Our exclusive focus is on residential real estate. ACM is not affiliated with any parties associated with the residential housing industry. Our mission is to bridge the gap in the residential housing market, where deficiencies in education, public policy, regulation, product structure, and personnel have created an environment where prospective homebuyers need objective information and useful analytical tools in order to help them make a prudent home purchase decision. As an investment professional, I have more than 15 years of real estate analysis experience, more than 10 years of institutional investment consulting experience, and more than 8 years of freelance financial writing experience. I am also the author of more than 25 published articles. For more information about my background, skills, and experience, please visit the Adkins Capital Management website. With this overview of ACM in mind, let me now turn your attention to our assessment of the JCHS report. The first section of our analysis pertains to an overview of housing stock. The general theme of this section is that there has been unprecedented home price appreciation across the U.S. During the second quarter of 2022, the annual release of the State of the Nation's Housing Report by the Joint Center for Housing Studies of Harvard University provided a wealth of information pertaining to the U.S. residential housing environment. The following is an executive summary of our pertinent findings. By the publication date of the JCHS study, the total number of homeowner households was 83.4 million. Some 6.1 million homes were sold nationally in 2021, an increase of 8.5% from 2020 and the highest level since 2006. The national homeownership rate was 65.4%. Some 2.2 million new homeowners were added on net between the first quarter of 2020 and the first quarter of 2022. Federal Reserve data show that, in aggregate, homeowners' equity soared by $4.3 trillion between the fourth quarter of 2020 and the fourth quarter of 2021 to $26.4 trillion. At the same time, the amount of mortgage debt outstanding rose by $823 billion to a total of $11.7 trillion. Home price appreciation nationwide hit 20.6%, marking the largest jump in 3 decades of record keeping. Nominal home prices stood 59.5% above the mid-2000s peak early this year, while real home prices were up 14.4%. For many current homeowners, soaring prices have brought spectacular gains in home equity, in turn exacerbating large wealth inequalities. With home prices continuing to rise, the savings, income, and down payment requirements needed to qualify for a home loan have skyrocketed, raising the financial hurdles for first-time and middle-income buyers. The second section of our analysis pertains to the implications of housing costs. The general theme of this section is that there has been record low delinquencies, but more than 1 million homeowners are cost burdened. In terms of the housing cost burden, mortgage delinquencies nationwide were at a record low in early 2022. However, many homeowners are facing very tough financial times. There were 689,000 loans in forbearance, indicating that many homeowners are still struggling to be current on their loans. Another 279,000 homeowners were delinquent on their payments and had exhausted their forbearance and loss mitigation options. And some 78,000 homeowners were in foreclosure proceedings. By the release of the JCHS report, 10% of all households, including renters, were still behind on their housing payments. The share of homeowners behind on mortgage payments was much lower at 6%. However, the share of lower income homeowners that were still behind on their housing payments was much higher at 17%. The third section of our analysis pertains to housing sales. The general theme of this section is that the demand for housing far exceeds for sale inventory. Sales of single-family homes were 5.4 million, while sales of condos and co-ops were 707,000 units. The average sales price for new single-family homes was $464,200 last year, with only 2% selling for under $200,000. Investors have moved rapidly into the single-family market since the pandemic began. The investor share of homes sold averaged 28% per month in the first quarter of 2022, up from 19% a year earlier, and well above the 16% share averaged in 2017 through 2019. Investors with large portfolios drove much of this growth, nearly doubling their share of investor purchases from 14% in September of 2020 to 26% in September of 2021. Unlike the previous run-up, when loose credit and speculative buying fueled a housing bubble, the current home price surge largely reflects years of underbuilding. In the current market, the number of households with sufficiently high incomes and savings to buy homes far exceeds the for sale inventory. Nationwide, housing markets across the country remain extremely tight. The fourth section of our analysis pertains to housing supply. The general theme of this section is that available homes for sale are at a 20-year low, but housing production is at a decade-level high. Fewer existing homes were available for sale in January of 2022 than at any point since the late 1990s. Inventory of existing homes for sale set a new low of 850,000 units in January of 2022 before edging up to 1 million units in April, still down 10% from the year earlier level. Inventory for sale consisted of 740,000 single-family homes and 108,000 condos or co-ops. However, high demand, low inventories, and rapidly rising prices propelled a sharp increase in housing production in 2021. Housing starts rose 16% last year to 1.6 million units, the highest total since 2006. Single-family starts exceeded the million-unit mark for the first time in 13 years. A building boom has lifted the number of homes under construction to the highest level since 1970. Moreover, starts of multifamily units continued to climb in 2022 to a seasonally adjusted average annual rate of 560,000 units. More multifamily units were started in 2021 than in any year since 1987. Multifamily construction has now topped 350,000 units for 8 straight years, after hitting that mark only twice in the previous quarter century. Shipments of manufactured homes exceeded 100,000 units in 2021 for the first time since 2006, jumping 12% to 105,800 units. Shipments of manufactured homes remained far below the 1990s annual average of about 291,000 units. With an average sales price of $108,000 in 2021, manufactured housing provides an affordable homeownership option for moderate income and entry-level buyers. Overall, housing markets across the country remain extremely tight. The combination of soaring demand and historically low inventories of available homes pushed both home prices and rents to unprecedented heights in the past year. The fifth section of our analysis pertains to housing production. The general theme of this section is that limited land, supply chain issues, labor shortages, and regulatory constraints are curtailing housing production. Residential construction is still being held back by supply chain issues, labor shortages, and regulatory constraints on home building. Chronic labor shortages and labor costs make it difficult for developers to build modestly priced housing. According to the Bureau of Labor Statistics data, construction job openings averaged 335,000 per month last year, the highest number in records dating back to the early 2000s. The pandemic exacerbated these challenges by causing a run-up in building material prices. Limited availability of land, high lot prices, and restrictive local land use regulations also pose significant barriers to housing construction. Housing markets are likely to remain tight in the near term. However, the steep rise in interest rates has already cooled homebuyer demand somewhat and should give inventories a chance to rebuild and help slow the pace of price growth. Given the constraints on housing production, coupled with rising interest rates, making homeownership less affordable, spending for home improvements and repairs should increase, as existing homeowners elect to remodel their homes rather than move to a new home. According to the JCHS study, annual homeowner expenditures jumped by more than 11% in the first quarter of 2022 to $391 billion. The sixth section of our analysis pertains to housing stock for the elderly. The general theme of this section is that existing housing stock is not designed to meet the needs of the elderly. The Joint Center has projected that the number of households aged 65 and over will grow to more than 50 million between 2018 and 2038. Some 17.5 million of these households will be in their 80s or older. The number of homeowners aged 65 and over climbed faster than the number of younger homeowners. The count of older homeowners was up by some 4.4 million over the past 5 years to 27.3 million. Although most of these older households were not new homeowners, rapid growth in the 65 and over population has pushed up their share of all homeowners to fully a third. As of 2019, more than 2 million households headed by adults aged 65 to 79 and nearly 1.5 million households aged 80 and over reported having difficulties navigating or using their homes. Problems with household ergonomics include multi-story homes with staircases that are difficult to navigate, stepways into and out of homes that complicate or prevent the ease of entrance or exit, narrow hallways that will not accommodate a wheelchair, split-level floor plans that are hard to transcend, and non-functional bathrooms that lack the necessary space or fixtures for efficient utilization. Without substantial modifications to the existing housing stock, the number of households with difficulties navigating or using their homes will rise dramatically in the decades ahead. Therefore, Beyond expanding the supply of both affordable and market rate housing, upgrades to the existing housing stock are increasingly urgent. Overall, much of the housing stock is not equipped to meet the accessibility needs of an aging population, and in many cases, the existing housing stock cannot be modified to meet such needs. With that in mind, modern high-rise buildings with single-bedroom apartments that meet the ADA provisions need to be constructed in mass quantities in every community across the U.S. in order to provide economically, efficiently, and effectively designed housing stock for the elderly. The seventh section of our analysis pertains to the Federal Reserve's monetary policy. The general theme of this section is that the Fed has set forth hawkish monetary policy via higher interest rates in order to curb inflation. The question raised by Adkins Capital Management is, why did the Fed cut the reserve requirement to 0% in 2020, and why is it still at that level? Historically low interest rates in much of 2020 and 2021 allowed buyers to bid up prices while still keeping their monthly payments affordable. The average rate on a 30-year mortgage hit a record low of 2.67% on December 17, 2020, and remained under 3% through most of 2021. According to the FHFA data, over half of the outstanding mortgages in the fourth quarter of 2021 had interest rates below 4%, including 13% with rates below 3%. Currently, the Federal Reserve is primarily concerned about reducing rampant inflation in the U.S. As a result, the Fed has taken a very hawkish monetary policy stance in order to bring the inflation level back to a reasonable level. Accordingly, the Federal Reserve raised the range for the federal funds rate from 0.25% and 0.5% on March 31st, and again to a range of 0.75% to 1% on May 5th, and again on June 16th to a range of 1.5% and 1.75%. To follow suit, the national average mortgage loan interest rate for a 30-year fully amortized fixed-rate loan began the quarter at 4.78% and ended the quarter at 5.7%. In comparison, the national average mortgage loan interest rate for a 30-year fully amortized fixed-rate loan reached an all-time high of 18.63% in October of 1981. In light of the Fed's policy position with regard to the federal funds rate, it is perplexing to try to understand why a major monetary policy feature that is at the discretion of the Federal Reserve is not being utilized or even discussed in order to combat inflation in the U.S. To explain, for more than a decade prior to March 26, 2020, the reserve requirement was fixed at 10%. At that level, the amount of money in circulation would have been curtailed to a level that would have helped mitigate inflation. Moreover, such policy strengthened the financial solvency of the U.S. banking system. However, on March 26, 2020, the Federal Reserve lowered the reserve requirement from 10% to 0% for all depository institutions. This policy provision dramatically raised the amount of money available to be in circulation, which in turn helped exacerbate inflation. Moreover, such monetary policy weakened the solvency of the U.S. banking system. With that in mind, it would be prudent monetary policy to raise the reserve requirement back to 10% in order to help curtail inflation, then examine its impact on the inflation level, and if still necessary, continue raising the reserve requirement until inflation is brought down to an acceptable level. Now that I have provided an overview of the events and trends that have taken place in the residential housing environment for the quarter, let me turn your attention to the proprietary finance-based analytical methodology and cloud-based residential real estate analysis software application that you can use in order to provide an assessment of the price level of homes in your community, as well as for specific home purchase opportunities. The Adkins Residential Home Valuation Analyzer is an internet-based software application that analyzes the relationship between the median home price level for a city and the median household income level for the city. With this information, the software application takes into account the most recent month-ending national average mortgage loan interest rate for a 30-year fully amortized fixed-rate mortgage loan, and the assumption that no more than 28% of pre-tax household income should be spent by homeowners in order to repay the principal and interest costs for their mortgage loan. By utilizing this information, the Adkins Residential Home Valuation Analyzer can accurately assess the price level of homes in your city. From the first analytical perspective, the Adkins Residential Home Valuation Analyzer determines the level of underpricing or overpricing of homes in your city by calculating the mortgage loan interest rate that justifies the price level of homes in your city. With this information, the justified mortgage loan interest rate is compared against the national average mortgage loan interest rate in order to accurately quantify and assess the level of underpricing or overpricing of homes in your city. From the second analytical perspective, the Adkins Residential Home Valuation Analyzer calculates the percentage of household income that would have to be spent by the people that live in your city in order to justify the price level of homes in your city. With this information, the justified percentage of household income amount is compared against the traditionally accepted household income amount of 28% in order to accurately quantify and assess the level of underpricing or overpricing of homes in your city. By utilizing the Adkins Residential Home Valuation Analyzer, you can determine the level of underpricing or overpricing of homes in your community, as well as the magnitude of underpricing or overpricing of a specific home that you are considering to purchase. This, in turn, will help you make a prudent home purchase decision. For more information about our finance-based analytical methodology and the use of the Adkins Residential Home Valuation Analyzer, please review our finance-based analytical methodology report on the Adkins Capital Management website and watch the wealth of movie presentations that provide an overview of how the Adkins Residential Home Valuation Analyzer is utilized. The eighth section of our analysis pertains to Adkins Capital Management's housing analysis. The general theme of this section is that the home price levels are overpriced in 46 cities that constitute the Adkins 60 City Home Price Index. With this overview in mind, let us now focus on the assessment of the price level of homes across the country. Based upon the justified percentage of household income amount, 46 cities that make up the Adkins 60 City Home Price Index were classified as overpriced for the quarter. San Francisco, Los Angeles, Honolulu, New York City, and Boston were identified as the 5 most overpriced cities in the index. In terms of a relative price level analysis, it is not possible to justify the home price level for the top 5 overpriced cities by reducing the 30-year fixed-rate mortgage loan interest rate from 5.7% to 0%. In order to classify the homes in the top 5 overpriced cities as underpriced, it would need to be deemed prudent by prospective home buyers to spend more than the respective justified percentage of household income amounts. In order to justify the median home price level for each city, the median required household income level would need to increase to a level within the respective range of $157,823 and $341,681. Based on the median household income level, the quarter-ending national average mortgage loan interest rate, and the assumption that no more than 28% of pre-tax household income should be spent in order to repay the principal and interest costs of a mortgage loan, the justified home price level for the top 5 overpriced cities fell within the respective range of $232,296 and $387,006. Prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the level of overpricing of homes in their community. On the other side of the spectrum, based upon the justified percentage of household income amount, 14 cities that make up the Adkins 60 City Home Price Index were classified as underpriced for the quarter. Detroit, Jackson, St. Louis, Memphis, and Wichita were identified as the top 5 most underpriced cities in the index. It is important to note that Wichita was classified as the 5th most underpriced city due to its lower justified mortgage loan interest rate amount. In order to classify homes in the top 5 underpriced cities as overpriced, the national average mortgage loan interest rate would have to increase from 5.7% to more than the respective justified mortgage loan interest amount for each city, which fell within a range of 8.8% and 19.7%, or it would have to be deemed imprudent by prospective homebuyers to spend as much as the respective justified percentage of household income amount for each city in order to repay the costs of a mortgage loan. Given the recent events that have transpired in the residential housing market, and taking into account the fact that buying a home will likely be the largest single financial transaction that prospective homebuyers will ever make, and the bulk of their net worth will likely be tied up in their home, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to analyze residential real estate from 5 financial perspectives. First, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the level of underpricing or overpricing of homes in their community. Second, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the largest amount of money they should spend in order to purchase a home. Third, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the amount of money they would need to earn on an annual basis in order to be able to afford to purchase a specific home. Fourth, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess total home ownership costs expressed as a percentage of household income. And fifth, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess how much a home would need to appreciate in value each year in order to offset the costs associated with owning the home. By assessing residential real estate in this manner, prospective homebuyers will be able to make a prudent home purchase decision. For more information about the Adkins 60 City Home Price Index, to watch our catalog of residential housing movie presentations, or to subscribe to use the Adkins Residential Home Valuation Analyzer, please visit the Adkins Capital Management website at residentialrealestateanalysis.com. This is Troy Adkins, saying thank you for taking the time to listen to this presentation.